I'm Rich Harvey, CEO and founder of Propertybuyer. Consumer sentiment has really taken a nosedive in the past 4 months, and the average consumer is not feeling very confident about the future. Rising inflation, interest rate hikes, and share market instability have really taken a toll. Living on a diet of negative news will undoubtedly lead most consumers to have quite a bleak outlook. Consumer sentiment simply measures what people feel about the economic outlook. I think we're all suffering a bit of doom fatigue. Remember, feelings are not facts. The herd mentality is one of the biggest influences in real estate. But is it all bad news? I came up with 6 factors driving the market down, the headwinds, and 15 tailwinds that support property prices. The factors that are depressing property prices include rising interest rates, depressed consumer sentiment, rising inflation and cost of living pressures, borrowing capacity diminished, global share market uncertainty, and affordability constraints. But on the flip side, the factors that underpin or support property prices include international migration ramping up, declining building approvals, listing volumes staying at 28% below the 5-year average, a growing and resilient economy that's bouncing back after COVID, very low vacancy rates, heading into a serious rental crisis, massive rental increases, low unemployment, strong household balance sheets, and borrowers being ahead on their mortgages. We also have high quality loan assessments by the banks, wages starting to grow, construction costs rising, which means the replacement value of your home is rising, and then the federal government initiatives like the Federal Help to Buy scheme, the New South Wales stamp duty reforms, and finally, property is seen as a safe haven during times of inflation. It's a hedge against inflation. I'm sure you can add more factors to each side of the list here, and we all have a natural bias in the way we think things will turn out. But there's several important takeaways to note. Firstly, interest rates are just one factor among many. Interest rates are still very low and normalising. I expect the cash rate to settle around 2 to 2.5% in the next 18 months, which will result in the average mortgage rate being around 4.5%. Now, the RBA can't raise rates as fast as they reduce them because there's more leverage in the economy. So interest rates are more sensitive to the average consumer. Secondly, the economy is growing and not collapsing. GDP growth is on track for 4.25% this year and 3% next year. And thirdly, headline property data is backward looking and typically 3 to 4 months out of date. So the conditions change a lot faster than what's reported in the media. For example, CoreLogic say that Sydney prices have dropped 2.7% for the quarter, but in fact on the ground we're already seeing prices coming back around 10 to 15%. So here's the rub. We're now in a buyer's market. There's so much less competition out there and vendors are more negotiable, but you do need to be careful with your property selection. These downturns don't last forever. Once prices stabilise and find a plateau, that won't be picked up in the official figures for 3 to 5 months down the track. So what I'm saying is the next 6 months will provide some of the best buying opportunities we've seen in years. And the best way to approach the market is to get ahead of the pack and not adopt a herd mentality. I'm Rich Harvey, thanks for watching.